Good morning, everyone, and welcome to today's webinar, the penultimate in our series. My name is Jessica Blumenthal, and I'm a director in the Banking and Finance Department at ENS Africa. Today's webinar, as I've said, forms part of our annual CPD series presented by the department to assist regulated persons in the financial services sector to obtain the CPD hours they need as part of their CPD requirements before the end of the cycle, which is ending now at the end of May. This year, we've presented 16 hours of CPD accredited masterclasses around topics that we think are important to consider for our shared future. Throughout this series, you've met experts from different departments and offices in our firm, all specialists in their own fields, but also working collaboratively as part of our ESG practice group to ensure that we explore the implications of developments in this field across all our disciplines, sectors, and throughout Africa. Just a reminder to those who are joining us for a CPD certificate, you will get your certificate emailed to you by the team within 3 days of this webinar, but please do remember that we do have to verify your attendance. So you must stay online for the full duration of the webinar. We need to get those stats, check them, and then if you were in attendance, we're able to issue the certificate. Then a final reminder of the cocktail party that we're hosting next week in our Cape Town and Johannesburg offices. It will be an opportunity for you to meet some of the presenters, depending on which office you come to, and just to ask any questions that you haven't been able to ask during the sessions, and really for us just to put a face to the name and to thank you for all of your attendance throughout the series. So if you haven't RSVP'd yet and you would still like to join us, please do so. You can still do so now. Then moving on to today's masterclass. So today's class provides both a primer on biodiversity and an opportunity to start unpacking some of the finance solutions being developed to attract capital to preserving the Earth's biodiversity before it is too late. And I'm joined in this discussion today by 3 colleagues: James Brand of our Natural Resources and Environment Department, Mansour Parker of our Tax Department, and my colleague Danielle Loubser, who is a Senior Associate in our Banking and Finance Department. James will set the scene for us, providing a foundational understanding of the importance of biodiversity for our economies and highlighting our dependency on ecosystem services. James will also touch on the building momentum behind biodiversity protection, for the first time now receiving equal consideration with climate change, and he'll give an introduction to South Africa's position with regard to biodiversity offsets. Danielle will touch on some of the financing solutions which have been effective in crowding in capital to ensure that a particular landscape or habitat conservation or restoration is secured. And I will touch on the nascent voluntary biodiversity credit market. Mansour will then take us through the various tax incentives which are available to encourage landowners towards the preservation of nature. Now, this webinar is a bit of a technical feat for us, so please do bear with us in case we have some technical difficulties, although we hope we won't. Parts of this webinar have been pre-recorded, as Mansour is currently traveling in Mumbai. He's attending a tax conference there, and I am currently sitting in Mauritius in our Mauritian office, where I've been intervening at a corporate governance conference. James and Danielle are in our Cape Town office. James's section has also been pre-recorded, but Danielle and I are live. We are available on this webinar, and so do feel free to pose any questions to us in the Q&A block. And as always, if we're not able to answer your question in the session, then we'll correspond with you directly after the session. So then let's get into the session itself. Cindy, if I can ask you to put the slides up for us, that'll be great. Thank you very much. So before we start the discussion and I hand over to James, just by way of introduction, I'd like to take you through some important terms which you'll hear come up during the masterclass. So let's start with the term natural capital. King 4 already includes natural capital as one of the 6 capitals to be considered by a company. And in so doing, it builds on a long history in economics of assessing the performance of a firm against its impact on vital capitals. Historically, for companies, the emphasis has been on financial capital. But as early as the 1970s, when the term natural capital was first coined by the economist Fritz Schumacher, there has been a realization that as our reliance on nature and the finite resource that it provides is so fundamental to our continued existence, the impact of a firm on nature should be considered as important it should be considered as important as the impact that firm has, that impact of that firm on the financial capital of its shareholders. Sorry, that's quite a mouthful. So essentially what I'm saying is that the realization that natural capital and the impact that a company has on natural capital, as operations has, is as important as the impact that a company has on the financial capital that the shareholders have contributed to the operation or the running of that business. So natural capital refers to the elements of nature that provide important benefits, which we call ecosystem services. And these ecosystem services include carbon sequestration or removal, protection from soil erosion and flood risk, habitats for wildlife, pollination by insects, and spaces for recreation and well-being. And James will touch on this in his presentation, as well as clean filtered water, which is another critical environmental service. So these benefits are provided to us free of charge by nature, and they're critical to all individuals and communities around the world. We can refer to the combination of soils, species, communities, habitats, and landscapes which provide these ecosystem services as natural assets. But currently, our economic systems allow firms, communities, and individuals to use these assets without payment and oftentimes without regard for their finite nature. We don't treat these assets in the same way that we would our own personal bank accounts or share portfolios. And yet, the irony is that if we lose these natural assets, we will be in a more dire situation than if we were to lose our financial assets. The idea of viewing nature as natural capital, recognizing the true value of nature's assets, is rapidly increasing in popularity, and it underpins this move that we're seeing towards biodiversity protection. Biodiversity and natural capital are sometimes used interchangeably, the two words. But biodiversity, which is essentially a contraction of biology and diversity, refers to the variety of life on Earth. The United Nations Convention on Biodiversity defines it as variability among living organisms, including diversities within species, between species, and of ecosystems. So while natural capital includes biodiversity, it also includes the flow of ecosystem services from this biodiversity. James will unpack further the risk that we're currently facing in respect of biodiversity and the impact that biodiversity loss will have on our natural capital. He'll take us through what this means for firms, communities, and countries financially. Half the globe is highly or moderately dependent on biodiversity and the ecosystem services that flow from it. And so it's no wonder that biodiversity loss is the fourth most severe risk in the 2023 World Economic Forum Global Risk Perception Report, and James will talk to this as well. Another term that's important for us to touch on before I hand over to James for his section is restoration. So restoration, rehabilitation, conservation, and protection are all critically required to conserve our biodiversity, to halt further loss, and attempt to regenerate and restore the previous degradation and damage that has been done. So James will talk about the Global Biodiversity Framework that was recently adopted and the commitments toward biodiversity that it contains. So this is a pivotal moment in our history as we shift from thinking about climate change and decarbonation in one silo and other environmental objectives in another. We have realized that everything is interconnected, and protecting and restoring biodiversity will ensure our continued ability to rely on ecosystem services, one of which is the sequestering of carbon and the cooling of our planet. It is not only for corporates to focus on decarbonization of their operations, which has very much been in the news for the last couple of years. They must also consider the impact on the landscapes and ecosystems in which they operate, and the risk to their operations posed by a loss of biodiversity upon which they're dependent for such services. So James will touch on the Task Force on Nature-Related Financial Disclosure Requirements, as well as the JSE Sustainability Disclosure Guidance, both of which frameworks highlight the need for impact on biodiversity to be taken into account by firms. The JSE Sustainability Disclosure Guidance, for example, whilst remaining voluntary and not mandatory on listed companies or other companies, it requires firms to disclose the amount of capital that they've allocated to restoration of habitat areas that are implicated by the biodiversity footprint of that organization. So this is important for our discussion that we will have around biodiversity credits, given that it signals it's a future factor, it signals at least a future factor if it were to become mandatory, that drives demand for instruments such as biodiversity credits. And this, together with other mandatory disclosure requirements, will have an impact on that market. And I'll touch on that more when we get to that section. The slide that you're seeing on the screen at the moment is an excerpt from the JSE Sustainability Disclosure Guidance, and circled in red are the two provisions I was just referring to, requiring disclosures around both the biodiversity footprint of a corporate or a firm, and then also the amount of capital allocated towards restoration. Thanks, Cindy. You can put the slides down now. The other two concepts that I'd like to just touch on before I hand over to James are the following. Internalizing externality. So this is a phrase that you'll hear used from time to time, and it's a concept that's quite important for our discussion today. An externality is an indirect cost or benefit to an uninvolved third party that arises as an effect of another party's activity. So you can think of this as unpriced goods involved in either consumer or producer market transactions. And you can see how this is relevant when we think about the currently free environment services which companies use in production of their income, and that I was mentioning earlier. So if we take an example of air pollution caused by cars. So the cost of air pollution to society is not paid for by either the producers or the users of internal combustion engine cars. This means that in the absence of an emissions or a carbon tax, there is insufficient pricing for this externality, which disguises the true cost and environmental impact of the production and use of ICE vehicles. Tax incentives, like the ones that Mansoor will speak about today, attempt to take into account a positive impact from a pricing perspective by allowing an incentive for landowners who seek to conserve or restore a parcel of land in a key biodiversity area. So this is a way of encouraging behavior and ensuring that there is compensation for the positive impact of the activities undertaken by the landowner. It's also internalizing an externality, although in a positive sense. In the same way, imposing a carbon tax on Eskom will price in the cost and the impact on the environment of producing electricity from fossil fuels. Pricing in this externality will correct the current market failure caused by excluding this cost from the price of electricity generated in this way. Excluding it makes for an unfair comparison with electricity that's been generated from renewable sources, which do not have the same negative impact on the environment. The difficulty with this example, though, is that we know that such cost, once internalized, will be passed on to consumers of electricity, which will have a social effect. Finally, before we go to James, I'd just like to touch on fair benefit sharing principles, because I think this is also very relevant, particularly when we think of the financing solutions for landscapes and biodiversity protection. This principle recognizes that no one owns nature assets, and as such, benefit to be realized from them should be shared fairly between all stakeholders, including indigenous communities who may hold traditional knowledge, which could be being exploited for purposes of profit-making, or who may be custodians of the habitat in question. So for example, in the context of biotech and pharmaceuticals, sustainable exploitation of nature can represent a way to protect biodiversity through realizing its commercial value, but this must be done on an equal and inclusive basis in order to ensure shared prosperity and not more inequality, particularly when that research and development or that R&D relies on traditional knowledge. Similarly, farmers in rainforest habitat should share in the benefits arising from sustainability certification of their products. They shouldn't only incur the additional responsibility and cost in ensuring that the impact of such products on the environment is mitigated. That needs to be shared. The cost needs to be shared through the value chain, as does the benefit. And this is another element that needs to be considered when we think about financing biodiversity protection. So it's certainly not simple. I'm going to hand over to James now to build on these definitions and to provide the fundamental background for our discussion, and then we'll pick it up there again to start talking about the financing aspects.
Thanks, Jess. So in this part of the presentation, I will provide a broad background to biodiversity and explore some of the drivers behind why biodiversity is becoming a new buzzword on the corporate agenda. Jess has provided us with a definition and understanding of what biodiversity is, but it's important to also contextualize the existence of biodiversity in the broader spectrum of time to fully appreciate this biodiversity that we have. The Earth is about 4.5 billion years old, and if that 4.5 billion years were to be condensed into 12 hours, microbes and bacteria appeared on the scene approximately 10.5 hours ago, animals approximately 2 hours ago, plants took root approximately 1 hour and 45 minutes ago, dinosaurs came and went in the last 35 minutes, and we humans arrived on the scene about a second ago. So for a very long time, Earth was largely barren and completely unpopulated, and in the spectrum of time, a biodiverse Earth is and has been a fleeting phenomenon, and we are relative newcomers. This extract on the right is taken from the recently agreed international law agreement, the Global Biodiversity Framework, that was agreed by nearly 200 countries in December last year, and provides that we are losing biodiversity at least tens to hundreds of times higher than the average over the last 10 million years. Unlike the previous 5 major mass extinctions that scientists can see from our fossil records that were caused by natural phenomenon, the 6th mass extinction that is spoken about in the GBF here that we're busy experiencing is being driven by our own activities in what is shaping up to be a massive own goal on our part, particularly if you think that us humans have only been on the field effectively for the last second. The image in this slide depicts what is known as the shifting baseline syndrome, where through ongoing environmental degradation, people's accepted thresholds for environmental conditions are continually being lowered. You may remember going on holiday in the family car and arriving at your destination with an array of different fragments of insects on the front of your bumper. You may have faded photographs of your parents or grandparents holding up large fish caught just off the shore. For the generation being born now, they don't have this baseline of how things used to be. In the absence of past information, our experienced members of each new generation accept the situation in which they were raised as being normal. But more and more studies are coming through indicating just how good exposure to nature is for us. A nature disconnect in our urbanized societies is increasingly recognized by medical practitioners as a possible contributing factor to some of the health and psychological issues that we witness in our urbanized societies. The World Economic Forum recently reported on studies which found that time in green spaces is linked to less prescription drugs being used, with the odds of someone taking drugs for a mental health problem falling 33%. And if there's a visit to urban green spaces 3 or 4 times a week, the likelihood of blood pressure medication falls by 36%. So we're starting to understand the physiology of nature exposure and its direct benefits. In the future, with less biodiversity around, the health and well-being of future generations are likely to be poorer for it without actually knowing what they are missing, as that nature simply won't be there. But aside from these micro issues around our own well-being and what this means for the well-being of the corporate human resources of the future, we're also starting to better understand the macro linkages between biodiversity and the functioning of our economies and societies at a greater scale. As depicted in the image on the left, we are gaining a better grasp of the fact that we fit within the thin living ecosystem that operates slightly above and below the surface of the Earth and are not necessarily the central figure around which this ecosystem rotates. In 2015, the United Nations General Assembly launched the 17 Sustainable Development Goals, or SDGs, to be achieved by the year 2030. The SDGs are the UN's blueprint to address the key global challenges that we face, such as climate change, inequality, poverty, environmental degradation, and the like. This image on the right indicates a tiered system to a depiction of the SDGs. A wedding tier cake is what they refer to it as, and shows how the 17 SDGs can be broken up into 3 layers. The environment as the first tier of the cake serves as the foundation. This supports society as the second tier, and then the economy as the third tier. Around 40% of total annual world trade between 2010 and 2019 was made of nature-dependent exports, while it's estimated that approximately half of global GDP is moderately or highly dependent on nature and ecosystem services that Jess was mentioning in the intro. Risk of loss of biodiversity has been reported in the World Economic Forum Global Risk Report of 2022 in the top 3 most severe global risks that we currently face at present and going forward into the next 10 years. The key takeaway is that biodiversity is one of the core foundations of the biosphere in this broader tier of the cake, and investment portfolio managers should be interested in whether we are operating within an identified planetary boundary for this particular aspect of our biosphere. If we are not, this will have impacts on the stability of our societies and our economies. The concept of planetary boundaries was recently made popular in the Netflix movie titled Breaking Boundaries, and explored the work undertaken by Johan Rockström from Stockholm University, who in 2009 led a group of 28 internationally renowned scientists to identify the 9 planetary boundaries that regulate the stability and resilience of the Earth system. Recently, scientists at the Stockholm Resilience Center confirmed that we had just crossed the safe planetary boundary for water use, taking the total breaches of planetary boundaries to 6 of the 9 identified boundaries in which we need to sustainably operate, as indicated with the red numbering in the slide. I'll briefly introduce you to 2 planetary boundaries that directly relate to biodiversity. The first relating to land system change, and the second relates to biosphere integrity, as indicated in green on the slide, in the images on the right here, the wording on the right rather. It's important to emphasize that each breach of a planetary boundary gives rise to physical risks to the environment that may be experienced by corporates, but there are also transitional and regulatory risks, as each of these planetary boundaries are at various stages of regulation in terms of applicable law. You'll see in the slides to follow that I've identified the international and domestic level laws which apply to these planetary boundaries. So just be aware that although they won't be unpacked in this presentation because there's not enough time, just be aware that these laws do exist, and it's anticipated that they will increasingly apply, and greater scrutiny will be applied to these boundaries from a legal point of view going forward. As regards land system change, the first planetary boundary relating to biodiversity, our natural ecosystems have been converted to agricultural land over time. While each hectare of fynbos, grassland or woodland that is cleared may seem insignificant on a local scale, the aggregated impact can have consequences for the Earth system processes on a global scale. Once humans figured out how to cultivate plants and livestock for regular sources of food about 10,000 years ago, they needed land to use. For centuries, the loss of greenery was relatively slow, but industrialization in the 1800s and mechanization in the agricultural sector rapidly sped up the process. As the graph shows at the top left of the slide, as our populations took off, natural and semi-natural lands started dropping as they were converted to croplands and grazing. Our forests have gone from making up 57% of available land to 38% of available land, and our grasslands from 42% of available land to 14%. The key takeaway here is that as our global populations approach and exceed 8 billion people, significant tracts of land are required to be converted for food and the production of goods to support this population, giving rise to large monocultures and consequent drops in biodiversity. As regards loss of biosphere integrity, the main drivers of change are the demand for food, as I've mentioned, water and natural resources, causing severe biodiversity loss and leading to changes in ecosystem services. This has come about through our increased change in land and sea use, climate change, pollution, prevalence of invasive species and consequent disease, as well as species overexploitation. The planet is becoming increasingly hostile for wildlife, with recent research indicating a 69% decline in vertebrate populations worldwide since 1970. It's estimated that wild animals now make up only 4% of global mammal biomass, with us humans making up 34% of that biomass, and our domesticated animals and livestock sitting at a significant 62% of global mammal biomass. So what is the relevance of all of this to companies or the financial institutions that are invested in these companies? Is there exposure to risk from biodiversity loss that is capable of cascading throughout the financial system? Many companies have direct or indirect dependencies on biodiversity through the critical and often hidden value of ecosystem services, whose true value is only crystallized on balance sheets when costing has to be done for human-engineered solutions to replace what is no longer there. For example, in the agricultural sector, the sector is dependent on water supply of sufficient quality to irrigate crops that are safe for humans to consume. This service is offered free of charge by nature in functional ecosystems, but this natural capital is not accounted for as an asset in the agribusiness sector. But when it's no longer there, this service will appear as a liability when the equivalent value of that service is costed when it comes time to develop water treatment facilities to purify that water, to acceptable irrigation standards. Another example for the agricultural sector is that it's estimated that 1 in 3 bites of food we eat, or 35% of the world's food crops, require animal pollination by bees, other insects, and small mammals. The presence of biologically diverse species of insects and animals has been found to support the stability of approximately 70% of the world's leading crops. In financial terms, the annual global value of crop pollination services is estimated between 195 and 387 billion US dollars, which is provided free of charge by nature services. This type of natural capital is not accounted for by agribusinesses, but it will appear as a potential liability in the future when the cost of manually pollinating our crops ourselves is provided for. Another example for the mining and construction sector is that biodiverse ecosystems provide a network of vegetation that absorbs water and holds soils in place, which are flood mitigation and prevention mechanisms. Stormwater management is a material consideration for the mining and construction sector, and the value an intact ecosystem provides to mitigate flood damage is only fully realized when engineered stormwater alternatives are costed when that ecosystem service is no longer there. And then finally, for the pharmaceutical sector, 25% of drugs used in modern medicine are derived from rainforest plants. 50% of prescription drugs are based on a plant-derived molecule, and 70% of cancer drugs are natural or inspired by nature. But only 15% of global plant species have been evaluated to determine their pharmacological potential. The loss of a vast repository of undiscovered genetic materials means loss of potential new drugs and treatments. And this is not just limited to land, as our impacts are felt in the oceans too. At present, we have recorded about 230,000 species in the ocean, but it's estimated that there are over 2 million species in our oceans that currently exist, that we are losing at a significant rate without knowing just what benefits such species may bring. And when those species are gone, they're not coming back, making it difficult to fully quantify the lost opportunity cost to the pharmaceutical sector and the consequent loss of benefits to humanity. So the key takeaway here is that corporate actors in the global economy depend on ecosystem services in different ways in different sectors. Ecosystem services, in turn, depend on the presence of rich biodiversity. The recorded loss of biodiversity leads to a decline in ecosystem services, which has the potential to pose a systemic risk to significant portions of the global economy. So to allow investors to get a better handle on these linkages and risks, there's been growing momentum towards greater corporate disclosures on biodiversity risks and impacts. At an international level, the recently published prototypes developed by the IFRS Foundation for the International Sustainability Sustainable Standards Board, or ISSB, and the Task Force on Nature Financial Disclosures, or the TNFD, provide for detailed guidance on biodiversity disclosures. In March this year, the TNFD released its 4th and final framework for nature-related risk management and disclosure. This release marks the final draft of the framework, with the TNFD on track to publish its final recommendations in September later this year. As part of the package of updates, the guidance documents released for 4 sectors: agriculture and food, mining and metals, energy, and the financial institutions. As we approach the September date of final publication of the standard, we can expect greater focus on this disclosure regime and its potential adoption globally, as we have seen with its climate counterpart, the TCFD. At a domestic level, in June last year, the JSE published their own guidance document titled JSE Sustainability Disclosure Guidance, which Jess mentioned in the introduction. And these seek to distill the international developments on disclosures and provide guidance to South African entities on their biodiversity disclosures. This is in anticipation of potentially mandatory disclosure requirements in due course. Relevant guidance is set out in the slide, and investees and investors should start becoming aware of what is going to be required, as the trend for greater disclosure and increased awareness of biodiversity risks can only increase going forward. Another significant driver for increased focus on biodiversity is the Global Biodiversity Framework that I mentioned earlier, that was adopted by close to 200 countries on the 19th of December 2022. The framework is made up of 4 global goals, as summarized in the bottom right of the slide, which are to be achieved by 2050, and a number of global targets to be achieved by 2030, as depicted in the slide. The 4 overarching goals referred to in the bottom right of the slide can be broken down into 4 targets relating to conserving biodiversity, which include biodiversity inclusive spatial planning, ensuring that at least 30% of our land and seas are conserved by 2030, ensuring at least 30% of our degraded areas are under effective restoration by 2030, and halting human-induced extinctions. 4 targets relating to avoiding harmful activities, which include stopping unsustainable harvest practices, alien species reduction, pollution reduction, and climate change mitigation. 5 targets on what we need to safeguard in order for people to accept the first 8 targets I've just mentioned. And this includes, among other things, providing for benefits to communities from nature's goods and services. And then finally, 10 targets on how society can achieve these targets, including transforming our policies and mainstreaming biodiversity into decision-making across government as well as business, mandatory corporate disclosures, as I've just mentioned, halving food waste, phasing out perverse subsidies, and strengthening and broadening capacity building. Legal frameworks will play a critical role in the implementation of such plans, so we can anticipate regulatory developments at country level in this space going forward to cascade the obligations and targets set at the international level by the GBF. And we're already starting to see this in multiple jurisdictions. But plans, goals, targets, and a regulatory framework will need significant finance to be breathed into the system for the GBF, or Global Biodiversity Framework, to come to life. And this is focused in Target 19, as seen on the slide. In this regard, the Global Biodiversity Framework set up a special trust fund, the GBF fund, to support the implementation of the Global Biodiversity Framework. It's estimated that an additional 700 billion per year is needed to safeguard biodiversity and conserve ecosystems leading up to 2030. It's calculated that 500 billion per year will be achieved by phasing out subsidies which have harmful impacts on biodiversity, leaving $200 billion per year being required by 2030. To mobilize that $200 billion per year, COP15 adopted the strategy for resource mobilization, which adopts a phased approach to this financing. But given the scale of what is required, these earmarked funds at intergovernmental level will not be enough, and leveraging private finance will be key to meeting the required targets. Of particular interest for the private sector is referenced in subparagraph D on the slide to the target of stimulating innovative schemes such as payment for ecosystem services, as well as biodiversity offsets and credits. My colleagues Jess, Danny, and Matsuo will shortly explore biodiversity offsets and credits in greater detail in a moment, as these will be key to incentivizing sustainable finance from the private sector. But before they do so, it's important to briefly contextualize where biodiversity credits may fit in within the mitigation hierarchy and how they may differ from biodiversity offsets. Biodiversity offsetting is the term typically used to describe the last stage of the mitigation hierarchy once you've avoided, minimized, and restored potential biodiversity impacts. This allows a potential development to result in no net loss of biodiversity, or even better, in some circumstances, a net gain. In 2022, under the National Environmental Management Act, or NEMA, our South African government published our own draft biodiversity offsetting guidelines that provide guidance on how offsets are to apply in the context of securing an environmental authorization. By contrast, the early indications of what a biodiversity credit scheme may entail is that these instruments are not intended to facilitate the offsetting of negative impacts on biodiversity. Rather, they are intended to finance real net gains for biodiversity above the break-even point in the slide that are not linked to negative impacts in another location necessarily. The principle is that biodiversity credits can be used to fulfill nature positive outcomes without being used for compliance purposes nor offsetting biodiversity losses elsewhere. It can be expected that the law will have a role to play in the future in regulating the biodiversity market, as it will be necessary to establish a legal framework that will give confidence to both the supply side as well as the demand side when it comes to things like biodiversity credits. The required legal architecture will be key to unlocking private finance to help close the biodiversity financing gap that was identified in the Global Biodiversity Framework.
Thanks very much. Thank you. I just want to pause here to reiterate the funding gap which James has identified. So James referenced the amount required annually to finance the goals set out in the Global Biodiversity Framework, the GBF, And I'm just going to ask Cindy to put up my slides again. And there's a graphic there that you'll see that's been taken from the Biodiversity Finance Handbook that was produced in April by Bloomberg NEF. And it puts the current funding deficit at around 830 billion if we are to reach the GBF targets by 2030. Now, this seems like a lot of money, but interestingly, it's equal to the value of the tobacco production industry in 2022 in a single year. And it's a far less sum of money than the cost to our economies of not taking action to prevent biodiversity loss, which is estimated to be $2.7 trillion US. So clearly we need to mobilize capital correctly to ensure the real world impact in line with the targets of the GBF. I'm going to hand over to my colleague Danielle, who's now going to take you through some of the financing solutions being deployed to prioritize capital allocation for this purpose. And she's going to talk a little bit about landscape financing. And then I'll come back on and we'll talk about biodiversity credits. Thanks, Danny. I'll hand over to you.
Thanks, Jessica. Cindy, next slide, please. So in this slide, we have set out some examples of finance solutions. And these solutions can be used to assist in meeting growing demand for business, while also increasing resilience to biodiversity issues, improving the governance of natural resources, and assisting in the restoration of ecosystems. So first, you'll see that we've got green bankable projects. So these are loans or investments that promote environmentally positive activities, such as the purchase of ecologically friendly goods and services, the construction of green infrastructure, regenerative agriculture, investment in renewable energy, or carbon capture projects. Next, we've got biodiversity offsets. As discussed by James, biodiversity offsets represent conservation actions intended to compensate for the residual, unavoidable impact on biodiversity caused by projects to ensure at least a no net loss of diversity and, where possible, a net gain. These can be differentiated from biodiversity credits, which Jess will speak about shortly. Next, we've got carbon payments or carbon markets. As Jess mentioned, the carbon markets permitting trading of carbon credits or offsets can be a mechanism to attract capital to landscape restoration, particularly reforestation. At least by imposing a carbon tax on emitters and regulating an offset regime whereby emitters can purchase credits or offsets, a further revenue stream can be unlocked, which can be used to fund restoration. Next is biodiversity tax incentive policies. As just mentioned in the introduction, tax incentives and subsidies linked to biodiversity protection can incentivize conservation activities by private sectors and are a way of internalizing externalities through compensation for positive impact. My colleague Mansoor will get into a bit more detail on the available tax incentives in South Africa linked to biodiversity protection. Next, we've got debt instruments. So loan and equity funding transactions and bond issuances, whether sustainability linked, green or social, can also raise capital for biodiversity protection, or can be used to incentivize business to take their biodiversity footprint into account by linking the sustainability performance targets to biodiversity restoration or protection. These instruments can also be linked to an outcome-based payment to ensure the success of the relevant project. We've also got grant projects. This refers to public sector funding from the government, and there's also funding from conservation NGOs and philanthropy. Lastly, we've got blended finance, which is a combination of private and public funding where the capital stack of funding is designed to encourage investment. For example, a grant donor may provide grant funding, or a government may provide a guarantee, which will enable private and institutional funding to be crowded in for that project. Next slide, please, Cindy. Okay. So the next item is landscape finance. And here we will have a brief overview of the principles of landscape finance and the landscape approach. So landscapes are socio-ecological systems in a geographical area made up of various functions. In order to achieve sustainable development within the landscape as a whole, an integrated spatial approach is required, which looks for appropriate synergies and trade-offs applicable to that area. The landscape approach to finance is an approach that integrates a number of the US Sustainable Development Goals, or SDG targets, It promotes integrated landscape planning and the creation of partnerships between various stakeholders in the community to achieve sustainability in the relevant landscape in the broadest sense. Why is this important? So this is important to ensure that our demands on nature do not exceed sustainable supply in the long run. Next slide, please, Cindy. So the landscape approach to finance is essentially about valuing nature and indigenous wildlife as an economic asset from a financial perspective. And so basically changing the way we see nature. Seeing nature as an asset creating value that aligns with conservation objectives, as opposed to merely a resource used in the production of business. This in turn creates a sustainable environment in which to do business and assists in the longevity of the business. It creates an intersection between finance and nature and looks for interconnected solutions for biodiversity issues. Where, for example, development finance is joined with climate finance or green bonds, it could have a greater impact on the landscape. This integrated approach to funding projects will be critical to meeting sustainable development guidelines. Currently, finance solutions tackle biodiversity issues in silos or at the project level. For example, we have development finance for developments and climate finance for climate issues. This way of tackling biodiversity issues can potentially undermine the landscape as a whole. And so in essence, the landscape finance approach utilizes finance from different sources, including public and private capital at the point of impact where it is needed most. It's about creating a toolbox of many different instruments and options that can be utilized for tailor-made concepts that work within the specific landscape. The intention should therefore be to identify the problems for the specific landscape in which the business operates and to find solutions relevant to that landscape, even that the issues faced in different landscapes are not always the same. The landscape finance approach therefore incorporates various stakeholders, including the government, the community, and the individual entity to provide blended finance solutions. I will now hand over to my colleague Jessica, who will continue the discussion on biodiversity offsets and credits.
Thanks, Danny. Thanks very much. And as you can see, I've actually put one of James's slides back up on the screen, because both James and Danny have mentioned the difference between biodiversity offsets acquired pursuant to an offsetting regime and biodiversity credits, which allows companies to support nature positive action and fund long-term conservation and restoration, rather than simply offsetting negative impact. And I think that this graph, which James had put up earlier, demonstrates this point really well, and you'll be able to see there the net positive or supportive role that biodiversity credits can play, rather than the compliance or offsetting role that biodiversity offsets can play. Biodiversity credits are a new instrument in the market. They are similar to carbon credits in that they represent an activity being undertaken to meet an environmental objective, but they're very different in what they measure. Also, carbon is fungible. So whether the carbon credit that we're talking about, a particular carbon credit is created through a reforestation project in South America, or a change in agricultural practices in Africa, the credit produced represents the same measurement of carbon which is being removed from the atmosphere. And this is not true of biodiversity credits, where preserving 1 hectare of rainforest in South America won't produce the same net gain for biodiversity or address the same biodiversity loss concerns for the planet as preserving 1 hectare of Afro-montane forest in South Africa. Because remember, as I said in the beginning, biodiversity is a contraction of biology and diversity. So we're aiming to restore the diversity of the species that we once knew, as James described with reference to the shifting baseline syndrome and the example he gave of insects on the windscreen, and he had that cartoon essentially that was on the slide. So it's therefore harder in the context of biodiversity credits to produce the credit in a way that they represent with integrity real world restoration of a key biodiversity area. And that's where the metrics that underlie the credit become so important. What's measured, how it's measured, and what the traceability and the provenance of that data is. A biodiversity credit, one that is backed by proper data, can be a powerful instrument for companies that are wishing to back up claims that they've made in respect of capital spent on restoration. And remember, we discussed that in the context of the JSE Sustainability Disclosure Guidance, which, as James indicated, is voluntary at the moment, but is a precursor of what we can expect in terms of mandatory disclosures for companies in the future. So a biodiversity credit could be really critical or useful to a company having to make such disclosures and reporting. Biodiversity credit would also be an instrument of interest to grant or philanthropic funders wishing to ensure that the real world impact that they are hoping to see with their capital is actually measurable and traceable, and that it's being achieved with their funds. So it may be a better way of ensuring that they achieve real world impact with the funding that they deploy. And a biodiversity credit would also be important as a way of mitigating key nature-related risk by a company. And that in future, remember under TFND, that key nature-related risk to a business will be measured, reported, and disclosed. And so it may be that the purchase of a biodiversity credit in an appropriate ecosystem, or referencing an appropriate ecosystem, may be helpful in mitigating that particular key nature-related risk that's been highlighted in respect of a particular business. So as we start pricing for nature, we'll start seeing credits which reflect several nature positive outcomes generated by a project. And we'll get to a point where a biodiversity credit will include a carbon credit, potentially a water credit generated by that same project, although there should of course be no double counting of the outcomes. In Australia, for example, there is already a biodiversity credit known as the Eco Australia credit, which was developed to fund habitat protection of a key biodiversity area currently under the custodianship of an Indigenous community or an Aboriginal community. An Eco Australian credit represents one Australian biodiversity unit and one carbon credit. So it's made up of a combination of the two. And the biodiversity element of it, the biodiversity unit, represents 1.5 square meters of habitat protection. So as I said, as companies start analyzing and disclosing their nature impact under TFND, then there'll be increased momentum in this market. We've just celebrated World Biodiversity Day, which stimulated a lot of public support and debate, and I think moved the general understanding of the urgency of this crisis forward. And today, actually, earlier today, I saw that the Science Based Targets Network launched their first science-based targets for nature. And this is the start of corporates being able to take ambitious and measurable action on nature and comparable action with each other. James has already touched on the developments in respect of TFND reporting. And so it's in this growing space that biodiversity credits will become more and more relevant. As voluntary biodiversity credit markets continue to develop, the complexity and the uncertainty of determining where to invest, what to measure, what outcomes to track will become less of a barrier to financial investment. But as James mentioned, legal policy and regulatory framework would really assist to give both the supply side, which is the product developers, and the demand side, the purchasers, the confidence that they need to really scale their investments in biodiversity at the necessary pace for us to be able to meet the GBF targets. There are bodies like the Biodiversity Credit Alliance, which is an alliance formed of field-based conservation practitioners and academics, and the World Economic Forum's working group on biodiversity credit markets. And that alliance is working together to assist with the development of the voluntary biodiversity credit market. But it is an emerging space that we're watching closely. There are a myriad of legal questions, such as who holds the legal rights in the biodiversity and the land or the seas that underpin the biodiversity credits project, who owns the credits, what legal infrastructure is required to enable the administration of the biodiversity credit schemes, the veracity and the integrity of the data, should biodiversity credits actually be regulated as financial products, particularly when they're traded, and how can we mitigate the risk of greenwashing litigation and enforcement action against the purchasers of biodiversity credits. So there's a lot to think about, but we are rapidly running out of time. So before I get too carried away, actually, Cindy, you can put my slides down because I want to give a bit of time to Mansour for us to just listen to Mansour's input on the tax incentives. And I think we are going to go slightly over time, so I apologize for that, but not too much over. And what Mansour has to share is quite relevant on the incentives. So I'll hand over to him now.
Thank you very much, Jess, James, and Arthur. That was excellent. It just goes to show what a developing area this is. And when areas develop like this, tax is never far behind in providing some sort of incentivization for certain types of activities. What I will do in discussing the tax is highlight 3 provisions. And because I'm a tax person, we tend to speak in letters and numbers. So therefore, it will be 37C and 37D and section 17. But to put these 3 sections into some sort of context is useful just to have a very brief overview of how it fits in within the overall scheme of the income tax design. There's 2 outcomes that we're looking for tax purposes. Number 1, what is a taxable income that I've derived? And number 2, how much taxes do I pay in respect of that taxable income? So we get to the taxes payable answer by multiplying the taxable income by the applicable rate of tax that applies to that taxpayer, whether it's a company, individual, trust, each one has different rates of tax. Then we get the taxes payable. But in getting to the taxable income, there's certain income that goes into the pot, and then there's certain expenses that you take out of the pot. Whatever remains in that pot, i.e. the taxable income, then gets multiplied by the tax rate to get the taxes payable. Now, what you take out of the pot is normally in the form of exemptions or deductions. So when a business incurs an expense, the question from a tax point of view becomes, is this expense deductible for tax purposes? Is it something that will have the effect of reducing my taxable income? And that's often where, from a policy point of view, National Treasury gets lobbied to introduce provisions that would not ordinarily qualify as deductions or might be difficult to qualify as deductions. And these are some of the deductions contained in the first 2 bullet points: the environmental conservation and maintenance expenditure, as well as the land conservation. And the purpose of these few slides is just to go briefly through what's required for taxpayers to benefit from these sections. And if we look at the first one, 37C, it basically covers operational type expenditure. And it falls within not the biodiversity credit box, but more closely aligned with the biodiversity offset box. And the idea is that we, a taxpayer, is going to impair a particular piece of land. Let's call it commercial land. And by way of example, they're going to build a lodge in the bush, and in building the lodge, this biodiversity will be lost in the construction phase and where the lodge will be built. Not the only example, but this is just, I think it illustrates the point a bit clearer. That taxpayer then seeks to conserve an adjacent piece of land in order to preserve the biodiversity, to make up the biodiversity lost in the commercial land, but then engages in conservation expenditure to preserve and maintain the adjacent land. What 37C says is it asks, have you incurred expenditure on the conservation land? And has that conservation or maintenance expenditure been carried out, very importantly, in terms of biodiversity management agreement that has a certain duration and entered into in terms of the NEMA Biodiversity Act? So environmental law will determine your obligations and what you need to do. Tax law doesn't do that. What you need to do is establish in terms of the Biodiversity Act. But once you've achieved those requirements, in the Income Tax Act says, whatever expenditure you've incurred in order to implement your biodiversity management agreement, that expenditure on the conservation land then becomes deductible, provided that that expenditure is deductible against the income which you earn from your commercial land. So that's where that linkage occurs. It can't be deducted against your general income. So if you bought a place in the Northwest and you've impaired certain of the natural landscape and you're incurring conservation expenditure, you cannot go to your local factory in Cape Town and say, well, that one's producing a profit. I want to set off my conservation expenditure that I've incurred in Northwest or in Mpumalanga against the factory which I have in Cape Town. It doesn't stretch that far. It's got to be. And if we look at the one box, does the commercial land include, consist of, or in the immediate proximity of the conservation land? So it requires a fairly close geographical proximity between the conservation land and the commercial land. So just to recap the test, number 1, have you incurred the expenditure? Number 2, is the expenditure in terms of a BMA, Biodiversity Management Agreement? Number 3, do you utilize land for commercial purposes? Number 4, does the commercial land, is it geographically is a geographical proximity between the commercial land and the conservation land, then the reduction is permissible, provided that the reduction is claimed against the income derived from the commercial land. The 37C contains two separate deduction provisions. The first one qualified as a normal deduction for income tax purposes. The second part of 37C asks the question of whether you are the owner. Have you incurred expenditure to conserve and maintain land of which you are the owner? And it references a different NEMA agreement. This one is the Protected Areas Act. Has a declaration been issued, again, for a certain duration of time in terms of the Protected Areas Act, then you will be deemed to have incurred expenditure under Section 18A of the Income Tax Act. So Section 18A has got its own particular regime. Section 18A is normally used as the a section where you're making tax deductible contributions to public benefit organizations, entities which carries on welfare and humanitarian services, educational services, health services, environmental and conservation services. And if they qualify in terms of 18A, taxpayers who make donations to those 18A approved organizations get a tax deduction. Now, 18A provides a deduction, but it also has many limitations. One of the limitations is that your 18A deduction may not exceed 10% of your taxable income. So when looking at the deduction provisions, one also needs to bear in mind any limitations that's contained within those deduction provisions, because it's not always the case that you spend R1 in 1 year, you can claim a reduction for R1. Sometimes you spend R1, your reduction is limited to 10% of the R1 or 20%. Other times you spend R1, but you can only claim the R1 deduction over 3 years or 5 years or 10 years. So it's important to bear in mind that R1 of expenditure is not always equal to R1 of deduction for tax purposes. The comparison between 37C1 and 37C3, 37C1 is the deduction, which I'll discuss in my first slide. 37C3 is the deemed donation, which I'll discuss in my second slide. I will not go through a line by line of all the items in here, but when the slideshow is shared, this detail could be quite useful just to bear in mind that there are two separate provisions. You could qualify for both or for one or the other. They're not mutually exclusive. It's not either or. So you could sit within both boxes, but they do have different requirements. The one requires a BMA under the Biodiversity Act of at least 5 years. The other requires a declaration under Protected Areas Act, the declaration lasting at least 30 years. They both cover operating expenditure, not capex, but they operate differently. So bear in mind the distinctions between the two. The second section, which I will have a look at, is 37 capital D. Unlike 37C, which deals with OPEX, operating expenditure, 37D deals with your acquisition costs for the land. And the question becomes, has the land been declared a national park or nature reserve under different sections in the Protected Areas Act? When I say different sections, I mean different sections to the previous 37C deduction that I had discussed. Has an endorsement been made to the title deed of that land that reflects the declaration? And does the endorsement have a duration of at least 99 years? So when those requirements are met, then you get a reduction of the acquisition cost of that declared land. And I put together a very brief example. I want to go through all the detail in the formula, but that detail is useful just to explain how the formula, what it's made up of. But let's assume that the parcel of declared land, or a piece of declared land, is purchased for 25 million, and improvements are made to that declared land of about 15 million for a total expenditure of 40 million. And under 37D, that expenditure qualifies for deduction. The 37D basis of deduction is a straight line method over 25 years. So you get a 4% deduction of the acquisition and capital improvement costs, provided that you claim that deduction over 25 years, which is a 4% per annum rate of period. So it has quite a beneficial impact on the cash flow, because the money would have been spent in year one, but each year there's this 1.6 million rand deduction that's claimed in your income statement against the income that's been incurred. So it creates a very nice tax shield for a period of time. There are some limitations in terms of the total expenditure must not be less than a low market value, municipal value, and that's where one needs to examine the detail, the granular detail within these sections, because most tax sections, they give the incentive, but then the incentive is subject to a number of limitations, conditions, exceptions, which is important to bear in mind. Now, unlike the first two provisions, those are provisions that will make expenditure deductible. And those two tax incentives, the first two bullet points, they favor taxpayers with good cash flow. Because when you have good cash flow, you're in a tax-paying position. So therefore, those deductions help. Once you have the taxable income, the effect of those deductions will be to reduce the taxable income and pay less taxes. They don't really favor taxpayers who are not in a healthy cash flow position. Taxpayers in that box tend to prefer cash grants from Department of Trade and Industry because that provides exempt income into that business which they can then use to grow. These incentive type provisions, they tend to favor companies with healthier cash flows so that they can then have a tax base against which to set up the deductions. In contrast, Section 17 provides an exemption from having to pay rates to a municipality in certain circumstances. And those circumstances would be whether the land has been declared a special nature reserve, national park, or a nature reserve under NEMA, Protected Areas Act, or if it's part of a national botanical garden under the Biodiversity Act. So one needs to test the answers, and if the answers to all the questions are yes, or in the case of the second box, no, the municipality may not levy a rate. The second box is, has the part of that land been developed to use for commercial, business, agricultural, or residential purposes? So it's important to bear in mind that notwithstanding the declaration as a nature reserve, you still need to ask the second question, has a part of the land been developed to use for those purposes, in which case the normal rates would apply. Now, what this provision means that your obligation to pay the rates to the municipality will you be exempted from that obligation. And we find that although it's in the law, in practice, it becomes a little bit difficult to implement. The process isn't that easy. Once you've got to go through environmental processes of making sure the land is properly declared under Protected Areas Act or Biodiversity Act. And then B, you've got to go to the local municipality and then seek the exemption from rates for that particular parcel of land. It just so happens that many municipalities, some municipalities are located in areas with huge tracts of land, which has been declared under the Protected Areas Act or under Biodiversity Act. The impact on the municipal rates can be quite huge for certain types of municipalities. So therefore, this particular concession is something that's not readily given. There tends to be a bit of a tug of war between taxpayer who's seeking the rebate and the municipality who's required to give the rebate. So that was a brief overview of my part of certain provisions in the Income Tax Act that seeks to incentivize biodiversity. There's no specific incentivization provision for biodiversity credits that was discussed earlier. And I like the interplay earlier on where we looked at biodiversity credits and compared it to carbon credits because they are different, but there's similarities in the way they are generated and audited and verified. And there was a time in the Income Tax Act where there was an incentive given for carbon credits. For the entities who generate the carbon credits, they will get an exemption on the first sale of those carbon credits. When the Carbon Tax Act came into place, and the Carbon Tax Act has this trading element for carbon offsets, it was then decided that the tax incentive is no longer needed to spur the carbon credit market in South Africa, and the tax incentive was dropped. It would be very interesting to see for the development of the biodiversity credit market, whether it could do with some form of tax incentivization to enable it to take root and grow. So that could be an issue that could make for a nice discussion with policymakers at Treasury. So thank you all very much for your time today. I will hand back to Jess for the closing.
Thanks so much, Mansoor. And thanks very much to all the attendees for staying online. I know we are 6 minutes over time now, but as I said, I think Mansoor's section was very useful and he certainly poses an interesting question to us and a potential lobbying opportunity toward the end. So thank you everyone for joining us. Appreciate the time. Tomorrow is the final one in the CPD series. So if you'd like to join us for a discussion on BE and some emerging issues for the financial services sector, please do, same time, online again. And yes, I hope we get to see some of you at our cocktail functions. Thanks very much. Goodbye.